This is Strategic Living. Transcript for Session 4. Discovering New Methods. Solidifying and Practicing Your Legal Status. This course guides shrewd, diligent individuals such as you through the most efficient means for accumulating the greatest possible wealth, even if you are already wealthy. This fourth session, Discovering New Methods, Solidifying and Practicing Your Legal Status, builds on your protection against privacy invasion and develops your protection against loss of income. Your fourth step to reach your financial prosperity goals. Would legally establishing and protecting your methods help you reach your financial prosperity goals? Your fourth step is to begin systematizing your activity. Begin privately preventing everyone from holding you back from realizing your prosperity dreams, contracting with legal enforceability for generating revenue, and generating as much revenue as possible through agency in the name of the tax-free organization. Before the modern wage became the norm, contracting was the way people made money. Whether they called it contract or barter or agreement or a handshake or just a man is as good as his word, they exercised their constitutional rights to contract for their labor and to exchange assets. For example, a sack of wheat for a day's labor, cash for the grocer's or pharmacist's bill, or a wagon for a plow. It was, of course, unnecessarily redundant to call it constitutional contracting, but that is, in fact, exactly what it was. Incidentally, if you have read the ebook beyond the recommended 42 pages, specifically Appendix 3, the Internal Revenue Code, you have discovered that the U.S. Congress has until now neither listed wages as gross income nor included wages in the list of items specifically included in gross income or in the list of items specifically excluded from gross income. This is consistent with never enacting any law requiring individuals to pay income-based taxes after the U.S. Supreme Court overturned the last income tax as unconstitutional, but enacting laws encouraging employers to withhold such taxes from earnings and requiring such employers to pay to the IRS the liabilities thus created. From the time individuals in the federal and most of the state Congresses began creating the appearance of an obligation to pay income-based taxes, people have grown increasingly unaware of their constitutional rights to contract for their labor and to exchange assets. And they have increasingly believed that the only difference between a wage and a contract is the type of form the payer issues to the IRS each year. While it is still truly redundant to call it constitutional contracting, it is distinctly different and characteristically much more befitting a responsible citizen than acting as, to use the more familiar IRS label, an independent contractor. Compounding. Interest earned on interest earned. If you have not already been following along with the transcripts, it is recommended that you do so for these last two sessions. The tax and interest PowerPoint audio presentation and workbook accompanying the second session demonstrate the enormous cost of taxes and interest without a plan to keep these costs as low as possible. They also demonstrate the enormous reward for putting your money where it can participate in the general upward movement of the market, but not participate in the various downward movements of the market. This enormous reward is clarified by the Rule of 72, which is simply a mathematical constant that indicates how long it takes for the value of money to double at a given rate of interest. The number 72 divided by the applicable interest rate equals the number of years it takes for the original value of money to grow 100%. For example, $100 placed in a 2% money market account would take 36 years to double or grow 100% to $200. 72 divided by 2 equals 36. It would take $1,000 18 years to double or grow 100% to $2,000 in a 4% certificate of deposit. 72 divided by 4 equals 18. Adding 4% interest to $1,000 at the end of the first year the new balance would be $1,040. Adding 4% interest to that balance at the end of the second year, the new balance would be $1,081.60, which reflects an additional $40 in interest on the original $1,000 and $1.60 in interest on the $40 in interest from the previous year. Near the end of the 18th year, the new balance would be $2,000. How does compound interest work? The key to such growth is the function of compounding. Not only does the base amount earn interest, but interest already earned also earns interest. The greatest accumulation of wealth can be realized over time by combining regular contributions with the best available rate of compound interest. However, as the tax and interest PowerPoint audio presentation and workbook also demonstrate, the greatest depletion of wealth can occur over time by combining regular purchases using revolving credit with an applicable rate of compound interest. As explained in the second session, the first part of efficient application of the Rule of 72 is plugging the drain for interest expense that can be avoided. The second part of efficient application of the Rule of 72 is generating the best available compound interest earnings for maximum frequency of doubling your wealth. For example, $2,000 placed in a 6% vehicle would take 12 years to double or grow 100% to $4,000. 72 divided by 6 equals 12. If you started at age 18, at 6%, that same $2,000 would grow to $32,000 by age 66. $2,000 at age 18 would become $4,000 12 years later at age 30. $8,000 at 42, $16,000 at 54, and $32,000 at age 66. Placing $4,000 in a 9% vehicle would result in $8,000 in just 8 years. 72 divided by 9 equals 8. If you started at age 18, at 9%, that same $4,000 would grow to $256,000 by age 66. $4,000 at age 18 would become $8,000 8 years later at age 26. $16,000 at 34. $32,000 at 42. $64,000 at 50. $128,000 at 58, and $256,000 at age 66. Naturally, continued contributions would make the amount at age 66 much larger. For example, ignoring the contributions in the next 7 years, another $4,000 contributed just in the 9th year would increase the value at age 66 by another $128,000. At 9%, $4,000 at age 26 would become $8,000 8 years later at age 34, $16,000 at 42, $32,000 at 50, $64,000 at 58, and $128,000 at age 66. Add that to the original $256,000 for a total of $384,000 from the contributions from just 2 years. Think what you could do with contributions from 8 or 32 years or more.